Dear investor, as expected, the last period was very volatile. Now, there were many causes, and we had pointed it out in the last video. However, the good thing is, as the causes of volatility were addressed, markets responded positively. After dropping sharply, the markets have retraced all the recent losses and are now actually delivering a positive return for the month. Let us look at how the uncertainties were digested during the period. Now, one, Russia, Ukraine have started to talk on resolution. Oil, which had shot up to over $130 a barrel, has receded from recent highs. This has been the single biggest factor in influencing market direction. As oil prices have come down, we have seen markets respond positively. The state elections resulted in return of the ruling dispensation in 4 states. Overall, the results were better than expected. On the interest rate front, the third point on which caused volatility, the first rate increases in the US took place. There was a fear that it would be aggressive 50 bip kind of an increase. However, maybe because of geopolitics, what we saw was a more measured 25 bip increase. And after the event, markets globally responded positively, maybe feeling that the economic growth is seen to be more sustainable. Yes, going forward, we will experience another 6 rate increases in 22 and a few more in 23, and the US rates could end between 2.5 to 2.75%. At the same time, given a much better macro situation in India, RBI has kept repo rates unchanged in the last policy. The other point which was causing volatility is the margin issue. Margin regulations for the stock markets were expected to come into force on 1st of March. They were postponed again at the last moment to 2nd of May, as has been the LIC issue. LIC issue is a large issue. It's not only large, it is multi times the size of the earlier largest issues. And yes, when it happens, it will soak away secondary market liquidity. And a good case would be that the markets consolidate in that period. Now, while the current round of volatility seems to be addressing itself, save for geopolitics and wild swings in the oil prices, which can still influence the market, the volatility could return in the month of May when LIC and the margin issues again come back and impact the markets. Markets have seen very large sell-off from FPIs. In calendar 22, the sell-off is already the largest the markets have seen in any 1 year. It is good that the markets have held its nerve through this sell-off. And this has been enabled by continued support from domestic investors and the fact that several of our domestic institutions have become now large and meaningful. It's not only mutual funds, it's also insurance, it is also pension funds and EPFO, where part of the monies do get invested in the equity markets. Moreover, the sell-off seems to be in liquid large cap spaces, financials and IT, and has been absorbed well by the market. The point to ponder is that when the sell-off dries up, assuming continued support from domestics, the market could deliver a nice bounce. On the economy front, sustained higher oil prices could impact economic growth. A ballpark $20 to $30 per barrel increase in price of crude would impact GDP by around 0.6%. It could be lower, and we have seen agency after agency reducing our growth trajectory for the coming 12 months. Higher crude prices, if they get translated into fuel prices, as yet the government has gone about it in a measured manner. It would impact consumer demand in India also. India is trying to buy discounted Russian crude if it is able to do so in large quantities. This is something which is available, let's say $20 cheaper than market. So if market is around 100, $20 cheaper, gets us back to the average prices that were being paid before the crisis erupted. However, Russian crude is just 1 to 2% of our refining mix. We would need to move that up to a much larger percentage if this is to have a meaningful impact on the prices at the fuel pumps. It could open up interesting profit opportunities, in case this happens. This is a hypothesis. Prices of products which are oil intensive and petrochemicals and stuff like paints, for example, and specialty chemicals, where the prices are linked to global prices, there may be a case of corporate India seeing higher profitability, because globally prices will be high for people who are sourcing it from countries other than Russia, while our input prices may be a tad lower. We will need to see how this develops. Coming down to the Russian situation, there are concerns around it. However, because international sanctions have been levied against Russia, my sense is it would only have a low impact on global economy. Size of the Russian economy is just $1.7 trillion. It is not amongst the top 10 economies globally. Moreover, it is a trade surplus economy and has more assets than liabilities abroad. This reduces the risk of any contagion in the event of a default on financial liabilities. Yes, while individual companies may get impacted on Russian inability to pay in USD, but on the whole, it would not be a problem. Ukraine economy is just $185 odd billion and even smaller. So let's look at it put together, they are less than 2 trillion economy. If we look at our linkages to Russia, it is again, small. Max exports from India to Russia were sub $3 billion. If we see it in the context of $400 billion of export that the country may do in financial 22, the impact is very small. On the listed relevant to the market spaces, pharma is one space where there can be an impact, as our pharmaceutical exports is 400 million, which is significant. However, pharma may be exempted by sanctions. It is always exempted, and there is a chance that if we get the rupee ruble arrangement in place for sourcing crude, we will need to sell more stuff to Russia, and pharma could actually gain from the arrangement. It could also gain because Western firms are exiting Russia, and it is opening up opportunities for Indian players. Once again, these are things we need to track over a period of time. Now, agri commodities may get a fillip. Russia, Ukraine are the bread baskets of Europe. Wheat prices have moved up, apart from other agri commodity prices. Now, India is a large wheat producer also, and FCI has large storage of wheat. We could export wheat from the new crop that is just about coming in. and the government money locked in FCI inventory can be released. That itself can be a big positive. Metal companies would gain from market access and better pricing. So Russia, Ukraine are large steel and aluminum producers, same stuff that India also is a large producer of. Our companies should expect better prices and more market access. Yes, world growth would be lower for some time because one of the large economies, Russia would be 11th, 12th largest economy in the world. It may not grow. And the other large one, China, is also suffering at the margin on account of COVID, and it's zero tolerance towards it. But the growth for the world X of these, should be as usual. And for some parts like India, which may step in and gain better market access, it could be a tad better. Overall outlook, yes, adjusted for the impact of crude prices. Going forward, as these things sort themselves out, the focus would turn towards results and valuations. We continue to expect strong numbers from India Inc. on an aggregate basis. Accenture results are already out. They do point to continued strength in the IT space. Now, of the large profit pools in India, IT is one of them, and the going there is now expected to be quite good. With the increase in oil and metal prices, the commodity space should also deliver very strong numbers, as should banks, which are seeing lower credit costs, thereby seeing higher profits. So the aggregate profits should be delivered. We should not doubt that. However, higher PE sectors like consumer durables and staples would be impacted on account of lower margins. We expect margin pressure on this part of the market to continue till Q2 of 23, with larger profits coming from low PE part of the market. We do expect some PE compression to happen for the market. On valuations, we continue to believe that 5-year averages are a good way to see what kind of return possibilities exist. The table that we have put out shows that there is a great possibility of the market to trade between 18,250 and 18,500. This does present about 7% upside from the current 17,300 kind of levels. And after that, we should see markets compound in line with the earnings growth. Now, these returns are lower than what equity investors typically like from the market, but they are still higher than returns from other asset classes. And we are talking index. Given that the earnings growth should continue to be strong and the retail interest in the markets continues to be strong as to flows into mutual funds, there is a great chance that the non-index part of the market could do relatively better in the period to come, thereby opening up significant alpha generation opportunities for active managers. I think industrial commodities are in focus. We have seen price flare-ups there. Steel prices in Europe are all-time highs. However, the sharp increases in prices, to my mind, should not sustain. They could sustain at higher than average levels for a longer period of time, but these levels seem to be unsustainable. As the supply chains normalize, as the geopolitics normalizes, the prices should be expected to drop, and with it, the valuations that this space enjoys in the market. So, this is a space which is, to my mind, ripe for a correction. Financials, where valuations have fallen while profit outlook has improved, is a good combination. That's a space we are positive on. China plus one has been an enduring theme there. The beneficiaries have now got an extra tailwind on account of shutdowns in China on account of zero COVID tolerance. After the up move that we have seen in commodity prices, some of them are already cooling off actually. In case the cool off continues, or in case cool off starts in some of the commodities which are still at close to their peaks, consumers and auto anchors can start to do very well. This is probably the counterpart of the market, and it could deliver a bounce as things normalize. If I look at the other large space in the market, software, there again the business momentum is strong, profit momentum would be good, but valuations probably do not leave much significant upside. So if you look at our portfolios, we have only a small presence there. We are still not very positive on the capex theme. Growth in capex X of PLI in financial 23 over 22 would be probably lower than the economic growth in real terms. In nominal terms, definitely lower than the economic growth. And it would take some time for it to revive on an overall basis and drive India's growth. In that space, probably cement and housing is something that does interest us. PLI is a big driver of capex, and that's a space where some interesting opportunities are emerging. Overall, in the market, there is a heightened risk perception, and it can't stay high forever. It shouldn't stay high forever. As it normalizes, market should be expected to deliver a bounce. Buying on dips, hence, should continue to be a great strategy. This is a volatile year. There would be downward dips in the marketplace. I think buying on dips, waiting for them, is going to be a good strategy. I do believe that our portfolios, which focus on high quality and high compounded growth businesses, present a good way to navigate these highly volatile times. Happy investing. Thank you.